Okay,
All right,
on to
good,
J-Rib.
Yep, good evening, everyone. It's meeting is called to order, 7:08 p.m. First item is approve the minutes from the June 25th, 2020 meeting. Can I get a motion to approve those minutes?
Who do we have on, Brian? Because I see some people left us.
Tom Conley.
Tom Conley's here.
Ken Brackfeld still
We
here.
have,
Ken Brackfeld. Tom
Jack
McCarthy's here.
Mahoney.
I'm here.
Jack Mahoney's here.
Yeah.
Tom
Russell
McCarthy's here.
Atkins.
Eric, you're
Russell
still.
Atkins is here still.
Eric Newman's here.
Eric is still here.
Yes.
Eric Newman is still here.
I'm still here, yes.
And Eric Caliper is still here.
Yes, Chris, I'm still here.
Okay. Caitlin, are you still here?
I see her.
Yeah,
We
Kate,
see her.
unmute.
Yep, I'm here, sorry.
Okay. So we're missing Chris Brand, Scott Pollock, Carolyn, Walter Burt, Russ Atkins, Brenda.
Russ Atkins
No, Russ is
here.
on.
Russ is here.
Russ is on.
Yes.
Brenda Kupchak and Bruce Ryan.
Brent, well, she, the first select woman was,
She left us. So we have 9 people.
Yeah, so we have quorum still, thankfully. So with that, I'll make a motion to accept the June minutes. Can someone make a second?
I'll second that, Tom Conley.
Thank you, Mr. Conley. All in favor? You can all just say aye. I don't need the names because if anybody's opposed or abstained, we can get those names. So all in favor? Aye.
Aye.
Hi.
Aye. Aye.
Any opposed? Hearing none. Any abstentions? Anybody abstaining?
Russ is going to abstain. I wasn't at the last one.
Thank you, Russ. So unanimous with the exception of Russ. All right. Go back to the minutes. The next item is the actual RFP. Kayleen, you just want to go over that real quick? I got your email, and thank you very much. And
Yep, so we've been working on it. I've been working with the purchasing director, Gerald Coley, on completing it. We've gathered other RFPs from other municipalities, one from the state that Brian's looked at, and our own RFPs from, I think, 2012. So he's been working on it. We have some questions that were sent out to Brian, Ken, and Carolyn just yesterday that we need some confirmation on from the JRIB, and also a draft of the scope of services. So we're going to hopefully get some answers on them and keep plugging away at it.
Carolyn's going to be the point, and I just because I personally can't take I don't have the bandwidth, but with Ken and I said we would help her out, and we'll get you those answers tomorrow. And I think the big picture is, yeah, we're just going to try and keep it simple because we're not asking for something that's unique. It should be well within the wheelhouse of Zach's rail firms. Great, thank you for that update. So are there any questions? All right. I keep losing the agenda. So next is the Brian Binkley. You're up here. Just do the pension and Ocad Performance review, and oh boy, update on the transition plan. It's been that's been fun.
Is Brian on?
He is, but he's muted. There he goes.
You got me now?
We got you now.
Okay. All right, good. Good evening, everyone. Yes, as Brian mentioned, my plan was to give a quick update on the transition that we performed for the pension plan at the very end of the quarter and fiscal year, and do a quick review of performance. And then I am joined, by Ariel Feingold again. She joined us on the last call to discuss private equity. And then at the committee's request, we're having HarborVest join us. Two of the managing directors from there, Ryan Gunther and Jamie Case, will be joining us in just a few minutes. But before they come on, and that's to address all of the questions that's outstanding, but for them to give an overview of their fund and their practice. They do have a hard stop at 8:30. So we'll, the most important is to answer all of your questions, and we'll take it from there. Let me jump in now and just give you the committee an update from the transition of the pension plan. So that all went really well. It was a lot of work and a lot of coordination with each of the managers, with People's Bank, and lots of signatures from Caitlin. But in all, what happened on 6/30 is that we liquidated the 7 investment managers that we could. And I say that we could is because we still have one outstanding with Wellington, and there's a lockup that we've discussed in the past that won't be liquidated until the third quarter. The instructions have been given, but it'll take until the third quarter to redeem. So all in all, that was approximately $275 million, I think it was, to be exact, that transitioned. So on 6/30, we sold those 7 managers, and then on the same day, so we're not out of the market, we bought 3 of the new Vanguard funds and then purchased more of the Vanguard International Stock Fund that was already in the plan. So that's been completed. A lot of work. And again, we stayed in the market. We didn't lose anything from that standpoint. And that explains, if we go to page 8 of the presentation, this is the Vanguard presentation. And from there, I'll jump into the performance to wrap up the fiscal year. But what I will caveat in the performance report that you'll see, it looks a little squirrely this quarter. It's because we held all the investments, the previous investments, until 6/30. So in the performance report, you'll see $0 values because they were liquidated, but we kept them in this performance report so you could see the performance through the whole fiscal year. And then you'll see the assets in the 4 Vanguard funds. So that's, again, it's a little squirrely this quarter for that reason. So on page 8, just to give you a recap of where the fiscal year ended, thankfully it ended positive. That was nice as the markets continue to rise in June. So I'm on page 8 again, is on the 1 year, absolute return of 0.72%. It did lag the benchmark of 1.99%, which I'll provide a little color on. That was mainly due to the active management. If I flip ahead, is if we looked at the OPEB account, that absolute performance was up 2.91% for the fiscal year. So a little bit stronger on an absolute basis, but that does reflect the different asset allocation. If we went to page, as we start to get into the managers of what drove the relative underperformance, when I looked at it, it was evenly split with your active managers, about half underperformed, half outperformed, but those that we had larger balances or a larger allocation to underperformed by a wider degree. So if I look at the U.S. equity piece, this is on page 10. Jennison did outperform, but what's not on the report is Allianz. That was liquidated back in in April. And as you recall, that performance through the end of April was down 43%. So that's obviously dragged on the U.S. equity results. International equity was positive, Euro-Pacific outperforming. And then if you went to stay on page 10 for U.S. fixed income, Sykes did underperform by about 32 basis points on the fiscal year to date. So that hurt the fixed income performance. If you flip down to page 11, the international fixed income was negatively impacted because PIMCO had underperformed. Hedge funds were mixed. Wellington outperformed, Invesco underperformed. So it was kind of mixed from a relative standpoint, but hedge funds did, from an asset class, lag the public markets. Private equity, which we're going to talk about more, that remains the bright spot in the portfolio, both on a relative and absolute basis. You see those returns on page 11. And also with your alternatives on page 12, real estate, as much pressure that's under, still did outperform on the one-year basis, 5.98 versus the 5.18. Commodities was the worst asset class on absolute basis. That was down 18%. The struggles that have happened there. And then the active manager, Gresham, did underperform slightly against their benchmark. So a lot of ground to cover there, and I'm doing it in kind of a quick fashion because I want to leave enough time for our partners HarborVest. I will pause there for a moment and just take any general questions or observations, or if Brian or Caitlin, I've left anything out. Hearing none?
Thanks.
Okay. Yeah, as I mentioned just very quickly, I already mentioned Ocad Performance. This is on page 17 of the presentation. I talked about how it was up 2.9% for the fiscal year on an absolute basis, but it did underperform its benchmark, and that is because the only active manager within the Ocad PIMCO did underperform by about 300 basis points, or slightly less than that. But that's what dragged on the relative underperformance. Both portfolios were within our targets as far as our asset allocation. We do in 8-1, we've raised cash for the pension payment, and we do have a capital call from one of the private equity managers on August 1st as well. So that's just the updating cash flows. Good. Let me, Ariel, do you want to turn it over to you to introduce our partners at HarborVest? Or again, any questions from the committee, please jump in.
Yeah, I'm happy to do so. And it's nice to see you all again from the last meeting where we had a really, I think, fruitful and productive discussion about private equity, particularly your allocation to the existing portfolio and future allocation, hopefully to HarborVest. And we were able to talk to you about Vanguard's entry into this space and our partnership with HarborVest. We covered some specific topics around the offer, and I know that the request was to then continue to have this conversation with HarborVest present. And so we're really excited to have HarborVest join us tonight to give you a taste of the firm that Brian and I did our best to explain, but I think in their own words, they can better describe for you. And so we have Ryan Gunther and Jamie Case, both managing directors at the firm, and they can speak to you at a high level some of the key attributes that we covered at the outset in some of our previous meetings, but as I mentioned, better in their own words. And then they want to leave the vast majority of their time for Q&A, continuing to answer some of the key questions that you raised in our last meeting. If you've reflected more since looking at the materials, I believe Brian sent the long deck from HarborVest talking through their capabilities. It's further detail from some of the previous decks you've seen from us, and that is intended as a pre-read. We're not expecting HarborVest to walk through those slides. I think what would be the most helpful is to use this time to answer anything you want to know from the words of HarborVest, best explained by Jamie and Ryan. So with that background. I think our plan is to have Jamie or Ryan give a little bit of background attributes, differentiators of HarborVest, and then leave it open to you. And as Brian mentioned, they have a hard stop at 8:30. So we want to be mindful of that timing for the rest of this session and really leave it to you guys to get what you need in that time period. So I'll pass it over to Jamie and Ryan.
Ariel, thank you. I just want to confirm that you all can hear me effectively. Excellent. Great. Let me start by thanking you for your time this evening. I know time has run away from us over the last few months, and we seem to be working on screens 10, 12, 14 hours a day. At least I know that we are. I'm sure that's the same for you. So appreciate you taking the time with us this evening. Second, I am delighted to keep watching the reports that Connecticut, like Rhode Island and Massachusetts, where Ryan and I hail from, continue to have good numbers around COVID, and I hope the town is faring through this crisis safely and without tremendous strife, although I'm sure it's quite challenging for all. Let me, again, thank you for the time this evening. What I'd like to do is start by introducing myself and Ryan, and then spending a few minutes talking about the firm, and then we'll jump right into questions. And we're happy to take firm questions, product questions, investment questions, whatever suits you and your time this evening. And despite Ariel and Brian's communication around the 8:30 hard stop, we're happy that if we still have outstanding questions, we can probably stay on for a bit past that to accommodate your time. I am Jamie Case. I am the managing director responsible for global investor relations at the firm. I've been at the firm for 5 years, and investor relations is responsible for all of our client-facing activities. Ryan predates me quite substantially, although he's far younger than I. He's been at the firm since 2004. He's a managing director in our primary team, a senior member of this investment group that is critical to this offer, as well as the core activities of the firm. Importantly, both Ryan and I have been charged by the firm to be the senior members of the team who are responsible for the Vanguard account in all aspects of the activities that we have at the firm. And we're delighted to have been working on this account with Ariel and the team for what is now over a year plus of time. I want to spend a few minutes discussing the firm and what we think really makes us stand out, and in particular, when combined with Vanguard, creates a best-in-class private equity solution for the town of Fairfield. As you get to know us more, you will begin to understand in detail that our focus is really about consistent investor outcomes, service and transparency delivered over the long term, because private markets are long-term investments. And that's how we define an enduring partnership. And for that really begins with our experience and our focus. So we have been in business for over 38 years now. We have invested solely in the private markets. We have no hedge fund activities. We do not invest in the public markets in any way, shape, or form. We have stuck to our knitting and innovated as our clients and the market opportunities have evolved over time. We've grown substantially over that time. We now stand at 650 employees, 70 billion in assets, and we offer multiple products that serve the needs of our clients, that serve the needs of our general partners, and ensures a continued partnership with our employees and the communities in which we operate. Importantly, the firm is a private entity. We are a partnership in all ways, shapes, and form. There are 50 people in the firm who own the equity of the organization. No one member of our firm owns greater than 7%, which we think is incredibly important, that this equity is diversified amongst the organization and allows us to fully focus our efforts on what is best for our clients and therefore what is best for the organization. Importantly, we took some very critical steps in the last 3 to 5 years to continue to recycle the equity so that the next generation of leaders of our organization know that there will be equity for them and that we, when we retire, will transfer our equity to them. That created an incredibly stable organization with virtually no turnover at the managing director level, in particular within the investment organization. We are integrated across all geographies and strategies inside the organization. And we feel that what's critical to us in that integration is how we work together to provide best outcomes for our clients. With those 650 employees, we're spread over right now 650 offices, but really we have 10 offices around the world. And those 10 offices were built because it's our view that to have the opportunity to understand and assess the investment opportunities available to us, you must be local, you must be culturally connected to your clients and to your general partners. But importantly, we also recognize that the needs of our LPs also are local. And so we have people on the ground to serve those needs. That has created a very diverse organization. We're quite proud that 4 of our 10 offices around the world are managed by and led by women managing directors in the firm. Importantly, we have dedicated investment groups. So I mentioned that Ryan is a member of our primary team. We have a direct investment team and a secondaries investment team. And each of those dedicated verticals are world-class in their own rights, both in terms of number of investment professional, the breadth of the opportunities we see, the scale at which we invest, the performance that we've delivered to our clients. But when taken together, when we drive that integration across the firm, that the primary team can assist the secondary and the co-investment team in terms of fine-tuning information flow and the opportunity sets that we see, we think this creates a unique and very powerful platform for our clients. Important to that ability to be effective is our access to our data. Private markets is, as we've described, private, and information flow is absolutely essential to be successful and to be effective. And over that 38 years, we've collected all of that data. We've invested quite heavily in technology and in quantitative research tools that allow us to mine that data, to look for pattern recognition, to spot great investment opportunities, as well as understand unique talents of individual general partners that enable us to find best-in-class opportunities and continue to work on that. But importantly, that same quantitative research is research and work that we've utilized in partnership with Vanguard to create what is the most effective portfolio construction for a Vanguard HarborVest product, and importantly, how we should think about clients' exposure to private equity in the context of their overall portfolio. And we think this is a strong differentiator. We built a unique product for the Vanguard HarborVest relationship. That unique product captures our primary capabilities, our secondary capabilities, and our co-investment capabilities. Each of those pieces add unique attributes to the overall offering that we think provides limited J-curve, strong alpha, highly diversified portfolio that will deliver in the long run a successful outcome for you and hopefully for all of Vanguard's clients. I'm going to stop there for a moment and take questions on the firm, on the product, on our investment capabilities. And as the questions come up, either Ryan or I will jump in and answer.
I think even before you start that, Jamie, I just wanted to share, I realize some individuals weren't in our last session where we talked through a lot of the questions that came up already. And one critical component to that was the Vanguard side and the immense search we went through to find an ideal partner, and how much conviction we have in the partnership with HarborVest, and hearing Jamie talk about the attributes that we tried to communicate, but I think he does so much better, helps just make clear to you all the strength of the partnership and the just incredible journey, search, and then very high conviction that the Vanguard team has, just to give you that color from our side. in the offer that you can feel free to ask questions about now. But I wanted to make those comments clear if anyone didn't hear that in our last session.
Thank you.
I see Tom McCarthy's got a question.
Am I that transparent? Yeah, I do. You mentioned data, which is the basis of your analysis. What kind of tools are you using? Are you tapping into other organizations who do that? I'm thinking like IDC and some of these other organizations.
Thanks, Tom. So I'll start with this, and Ryan, you can jump in and add to it. So for starters, the most important source of our data is our own information on the investments that we have made over the 38 years. So every single portfolio company is in our database going back for that entire time period. Additionally, and we followed them all the way through, so we understand them in detail. That data is also captured by the general partner and by the fund in which we invested. Importantly, though, we have, and Ryan can speak a bit to this, an open door policy in our due diligence process. So any GP that wishes to raise capital, we will meet with, and we will gain as much information and data that we can from those general partners that is also input into our database. So this is a highly unique database to us. We've supplemented that with outside sources, primarily for us, some of the best source of additional information on behalf of managers is Burgess, and we utilize their data. But also, as we continue to work with more and more very large entities around the world, we're helping them evaluate their portfolios that they've invested with outside of their HarborVest relationship. And so we continue to add to the database even more. Ryan, did I miss anything you'd like to add to that?
No, I think you covered a lot of it. The database, it's important to note that it goes back over 30 years in terms of information. And so we built a proprietary database back when the firm was originally founded in the late 70s, early 80s. And that data has been tracked over time. And so there is the fundamental ability to go and run statistical analyses, whether it's our risk and analytics team who's building portfolios to understand correlations and in certain areas, whether it's sector diversification, time diversification, underlying vintage year, as well as vintage year across the life cycle of a company diversification. So that helps us build the portfolios. But on the investment side, as we use our database, we're able to go back and understand the strategies of underlying managers. We're able to understand the key merits and the key risks that we saw with specific managers when they raised their last fund, 2 funds, 3 funds ago over time to see the evolution of those organizations. And we're also, we have the ability to track underlying company information. And that company information, when we sit across from the 800, 900 or so managers that we meet on an annual basis who are raising funds globally, they're sharing with us very private information. This information is not available in the public domain. You can't go to a Bloomberg and pull it up. And so that information is really critical to making the best investment decisions. And we capture all of that. And what that does is allow us to drive to our data analytics when we're evaluating a fund. So a fund manager comes, we want to understand their strengths and weaknesses, where they're investing, what their strategy looks like, different sector exposures and how they perform. So full ranges of analyses on that specific manager. But then when we think about the integration across the platform, that data comes in through our primary platforms where we're meeting new managers. We're seeing secondary transactions where underlying LPs are selling, and we as a potential buyer of those assets will have access to the underlying data of their portfolios. And then on the direct co-investment side, we are meeting with and sourcing hundreds of deals on an annual basis and getting that information. So that's all being forwarded back into the database, but it's important to capture it. It's what you do with it. And we're very focused on using that data to make the best investment decisions.
Sounds like a lot of structured data. As it was initially described to me, I thought it was experiential, which you converted to more structure, but it sounds to me it's structured from the beginning.
Structured from the beginning, yes.
That's right.
Eric,
And it's,
developer, I'm sorry, go ahead, Brian.
oh, I'm sorry. I was just going to say it's structured, and it's also, if you get data at one point in time when a manager is raising, say it's year-end information or quarterly information, that information can become stale. And so it's also important to talk a little bit about our monitoring approach and how we think about our ongoing interactions with general partners to keep that information fresh and current. And so we are not only with the managers that we're investing into who are reporting to us on a quarterly basis, we're getting that information clearly as a result of being an investor, but we're very proactive in our monitoring efforts and going out on every 3-month or 6-month basis and making sure that that information is refreshed so that as managers are coming back to market in 6, 12, or 18 months on the primary fundraising side, we're able to form an investment view around how the trajectory of the firm has progressed, how the performance has progressed, and as a result, we can be much more quick and crisp in our decision making and our conviction about which managers we want to invest in. We can anticipate where LPs might be selling, and then we can also identify companies that may need capital where we can be a co-investor.
Eric, I know you had a question. I saw you.
Yeah, just a quick question. I see here that you recently hired a co-CFO at GUI. Can you speak to that and give us a little color?
Absolutely. So we started a search. Well, let me step back a second. One of the important areas of focus for the firm over the last 5 years has been to continue to invest very thoughtfully in areas that are important to the firm's growth. So I'll put myself into this group. We did not have a head of client facing. We saw our business growing exponentially and felt that we needed somebody who had done that for their entire career, as I have. Far more importantly, we recognized the need to invest heavily in technology and upgrade ourselves. So we got a senior technology officer from the Hartford, who was the CTO at the Hartford before coming to HarborBest. At the same point, we have had a CFO for the funds and for the management company who's the same person. And as our fund complexity has grown, the needs of that role have become very critical to the fund's activity, but we needed to make sure that we had focus on running the firm because we've really grown quite substantially. And so about a year ago, we began a process of interviewing the marketplace to find somebody who was not just a fill-in, but somebody who could take us to the next level and really challenge us. We're very fortunate that Rob, who was sort of the number 2 deputy CFO at Apollo, was looking for precisely that kind of next step in his career. And he saw the opportunity to help us become even stronger and even better. And so Rob literally just joined, I think it was last Monday, the second week. I was part of the recruiting process. I was very excited that he was joining us, and he's been at the firm for, as I say, for 10 days, and it's just refreshing the kinds of questions that you're getting from that kind of talent.
I know there's something that Jamie hit on early. And Ken, I know Ken was on the phone earlier, but it was a question that he had brought up at the last meeting. It was, how to retain that talent. And, I think Jamie did hit on that because that was a question of, as it relates to key personnel and the continuing the performance track record, because performance track record was something we showed last time. So I just wanted to bring that up in context of what Jamie said to a previous question with Ken.
Brian, it's worth just spending a couple of minutes on that because it is central to the firm's success, quite honestly, is the ability to retain this incredible talent. So it starts with the partnership model that I described, but it also starts with the whole recruiting process. So we operate on the investment side almost in an apprenticeship model. So we take individuals fresh out of an investment banking associate experience or an experience akin to that. They come up to HarborVest for a couple of years, they'll go back to business school and then come back to HarborVest, and they'll stay the rest of their career. And they'll grow with the firm as we grow. Now we do that because, again, there's a certain ethos and culture of the firm that attracts and keeps a certain type of person. We are not a star system. We are all about the firm's success broadly is our success, and that's our client's success. And that's part of our compensation structure. It's about the accession to partnership and equity ownership in the firm. And so all of our folks look at that opportunity set. If they are one of those star seekers, they probably won't last past the associate level, to be honest. But if they are part of a firm and want to be part of that firm, they find that this model, this broad-based partnership integrated model across the board is quite appealing and quite attractive for them and as well for us.
And the only other thing that I'd add to that, Jamie said, is we give a lot of responsibility to our junior professionals. And those junior professionals, particularly in the primary group, when they come in, they have exposure to, because of how integrated we are across the platform, even though they may just be primary investors and part of the primary strategy team, they have access, they have interactions, they have ways to contribute across secondary as well as co-invest. And so, the way that we're structured, it gives an investment professional the ability to see the full range of channels in which you can invest into private equity. So new funds being formed, co-investments as they're being built out and completed, and then also secondary transactions as those assets are trading in the market. And then as we think about just over time, Jamie mentioned the associate to kind of more senior role. My experience was just that apprenticeship model in the same path that he described. I joined on as an associate. I had 2 to 3 years as an analyst at a consulting firm previously. I was part of the primary team, contributing over the course of 2004 to 2008 in primary commitments we were making. And then from there, went back to business school. And I worked with HarborVest to identify that I had a real strategic and long-term career interest in coming back to the organization. HarborVest, there was a mutual decision to bring me back. And so when I went off to business school, I actually spent my summer at business school in our Hong Kong office, learning about the Asian markets and spending time with our Asian colleagues and contributing there prior to coming back. So getting a more well-rounded view of our business. I came back to the Boston team, but as a result of that experience in Asia, I have spent time traveling to Japan, traveling to Beijing. There's a lot of inter-office interactions that take place. And then the other part of it, I haven't made the transition over to other groups, and not many folks do, but there is that opportunity if you start on the secondary side, for example, and come back from business school and want to be more of a direct investor. There also is that opportunity to find your path in HarborVest and the path that's best for the firm and, of course, for our investors. And so there's that real open-mindedness to the apprenticeship model, but also building a career that's best for the individual, their strengths and their areas of interest.
I just have one more question, and then I'm pretty much all set. How do we make sure that we don't have overlap with HarborVest, with our current private equity firms, Mesereau and Lexington?
So first, we need to see the underlying investments that Lexington and Mesereau have. That is something that both of those firms, with your support would provide us so we can show you where that potential overlap is, because we are somewhat viewed as a competitor of those folks. They won't just give it to us if we ask. So we'll need your support in that regard. But importantly, what we have found over the years is that our business models are different from many firms. And so therefore, while there is some overlap, there's not a substantial overlap. And that oftentimes we're able to manage our way through that. Having said that, we will be through this offer coming into a fund, and that fund will be making a set of investments. So we'll have to monitor what kind of overlap is being generated by that effort on a go-forward basis. And it will also depend upon how many remaining commitments those particular funds have left in them, as opposed to the fact that they're already older vintages.
I think if it's helpful to give another data point. Oh, go ahead, Brian.
Yeah, it was maybe if Brian could speak to that, but I know when I've looked at just at the high level, Ryan would know some of the investments and Jamie better, but some of those existing investments were made many years ago. One of the Lexington was 2009, I believe. The next fund was 2013. So there's also that piece of it, different vintages, there's going to be some runoff, and keeping that in mind. And I think we brought this up at last meeting is if there's no further commitments to private equity, which is up to the committee's discretion, those portfolios will slowly run off over time. And it's a question of being an allocation to private equity as well.
Yeah, if it's helpful to hear other data points from other clients who are committing to the HarborVest fund but have legacy private equity investments, the way they've handled it is just as Jamie described. So they've given Vanguard some access to their past underlying statements to look at exposures. It's helpful to understand where there are firms that may overlap, but ultimately the conclusion after that kind of high-level analysis was that a lot of those had earlier vintage years. There isn't overlap in fund, even if there's overlap in manager. And then the vintage year diversification, where I think Brian and I spelled this out on what a program might look like to maintain an allocation, which would run off without recommitments, has built-in vintage year diversification that would ensure there would be no exposure if those commitments don't re-up. And then there's continued investment to keep your allocation to private equity through HarborVest.
So this is Jack Mahoney.
Yeah.
If I could ask a question.
Okay.
Brian, is that okay?
Go ahead, Jack. I got like 4. So I'll unload mine once you do yours.
So my question is the program that you're speaking about, if we were to move into that, we're quite happy with Lexington and with Mesero. I'm wondering if Vanguard, if you have enough information or maybe the courage just to try to take a swing at what's the benefit of going with HarborVest, and how do you compare and contrast to Lexington and Mesero?
Yeah, I'm happy to answer that and would welcome the rest of the team from the Vanguard side. But a lot of what we've done to this point was combing the private equity landscape, looking at firms like Lexington and Mesero specifically, and their capabilities, alignment, performance. And what we found through that process, and Vanguard has been quite able to look at a number of different really top firms and pursue some kind of partnership or arrangement. But we looked very highly at the caliber of those managers and didn't find them of the same level that HarborVest is. So I think it's a fair question, and we wouldn't try and pit several managers but part of what we're bringing through this partnership is the understanding that Vanguard's really developed and mature manager oversight and search did come through those and ended up coming to HarborVest as our chosen partner. So I think it'll be helpful to talk through if the funds, you go forward with HarborVest and let the others run off, what the exposures are and some similarities in firms, which is a possibility between those two managers. But I think what we're coming from, Brian Binkley and I, is the long search and tested strategy to bring us to HarborVest. And so that would be the Vanguard very strong recommendation from our side instead of any other private equity manager, which is a great question that have come up with other clients in the same spot with legacy PE trying to help evaluate. And what has been so helpful is partially Vanguard's long search up until this point in bringing the offer. I don't know, Brian Binkley, if you have more on that take, but we've been through that journey.
Yeah. Two very quick points, because one of the questions did come up last time, would we sell the existing private equity investments? And that would be absolutely not. That would hurt the value of your existing investments. So we're not looking to touch any of the existing commitments that the town has made. So that was one. And then, that search process that we went through, it was well over a year, I believe, Ariel, right? this wasn't, Jamie, you're shaking your head. Yeah, it was, I wasn't a part of that team, but there's a private investments team that's dedicated to this in Vanguard, and it was well over a year, I don't know, maybe even 2 years. Jamie,
yeah, 2 years of search. That's right, Brian.
So look, the only thing I'll add to that question, and I think very highly of Lexington and Mesereau, but when I look at the fund that we've created with Vanguard, which is the marriage or the integration of our primary capabilities, our secondary capabilities, and our co-investment capabilities, that combination of portfolio we think is quite unique. But what drives its success is that each of those underlying investment disciplines are world-class in their own right. And then pulled together, it's really, we believe for our clients is 1 + 1 is more than 2. And that's one of the powers of this fund, as opposed to a standalone secondaries manager or a standalone primary fund manager.
Thank you. Hey, Brian, I've just got one more quick question. And for HarborVest, and that is how should Fairfield think about or evaluate risk in terms of the difference between Lexington and Mesereau and you guys? Is it pretty equal? Is it a risk reduction? How should we look at that?
Well, again, it's a little hard to answer that question explicitly without deep knowledge of those individual portfolios and which Lexington funds and what is the construct of those funds. We would tell you that the combination of the 3 strategies collectively and our investment approach for those strategies over the investment within those strategies over the next couple of years will create a very thoughtful and diverse portfolio with a very strong risk return dynamic attached to that. This was one of the key elements of focus we understood in the Vanguard diligence of us in how these strategies could be melded together and how do we create a portfolio that optimizes returns at a level of risk. Ariel, I don't know if you have anything else you would offer to the question.
Yeah, it was intentional in the Vanguard. I think very critical to our ethos and philosophy was somewhat conservatism in looking at this space and making sure that what we can provide is return enhancing on a risk adjusted basis. And so what was key in Vanguard's view, and by the way, Jamie's completely right, the portfolio construction that you're getting is HarborVest's best thinking with Vanguard's influence, drawing from a lot of our philosophical principles for diversification. And so this is somewhat of a breath of fresh air, I think, relative to a more concentrated portfolio or concentrated manager or strategy, if we're talking about some of these managers like Lexington. And so it was quite intentional to have a broadly diversified investment product through private equity that was very aligned with Vanguard's thinking and with very much risk in mind, reduction through diversification. So it's a roundabout way of saying it was aligned philosophically and how we thought about risk reduction for this product.
Is that good, Jack?
It is. Thank you.
So I have a few questions, and some of them are carryover from last month. And one was originated. So Jamie, you said something about reducing the J curve. I don't know if you want to explain exactly what you mean there. And then, so while we're on the performance and terms, we had a little bit of we had quite a bit of discussion about the length. It's both from investment window and the overall term and the extension. It seemed pretty long. And given the way that you guys appear to be doing vintage years, or not years, but vintage, it looks like you have enough volume that you're probably going to be rolling out a fund either every year or darn close to it. So I didn't quite understand why you needed such a long window there. And then how you guys, when you look at sort of how you posit your returns, some mix of IRR, multiple of our true invested capital, how we were supposed to look at returns with respect to distributions and sort of net capital and stuff like that. Given that you guys do direct stuff as well as secondaries, and so there's three questions there: length, your J curve, comment, sort of your performance measures.
Ryan, do you want to take most of this?
Yeah, sure, happy to. So just on first, you'd mentioned the J curve. So the way that we think about the private equity experience, and you get some of this with any secondary type portfolio that you might build or that you might incorporate, as we're doing into the HarborVest Vanguard Fund. The way to think about the J curve is really as a private equity fund is beginning to start its investment period. And so investment periods last for 5 years. Liquidation or selling periods last for 5 years. And then there's oftentimes a 1 to 2 year extension of a private equity fund. So the overall term of a private equity fund, even though it may be 10 years, it often ends up being 12 years and sometimes beyond as assets get sold later in the life, something that's residual and been held onto for an extended period of time. As that manager starts to make investments over the first 5 year period, really in years 1 and 2, they're investing into companies. Oftentimes those valuations are kept steady at cost. So they may invest $100 million into an investment and hold that investment at $100 million for a year or 2 years as they're making operational improvements, as they're working through some management upgrades and augmentations, as they're thinking about new sales channels, but really repositioning or growing the business. And as a result of that, the capital's going in, it's staying at cost in terms of the valuation, so a 1x, but the underlying manager is charging fees on that fund. And so those fees get deducted from the value. And as a result, the net return back to investors goes negative for a period of time. And so you can have a point in a fund's life where you may be 1 to 2 years in. And as a result of that, you're in negative territory, which is where the term J curve comes in. The way in which we mitigate that J curve is through the use of secondary transactions, as well as direct co-invest, but primarily the secondary portfolio. And so the way we're building the Vanguard HarborVest Fund is to invest in the primaries over a 3-year period. And then for the secondaries and the co-invest to front-end load those over the course of 2 years. And the secondary transactions, oftentimes when we go in and we buy an existing limited partners position on the secondary market, we're often able to buy that at a discount because there is a need for that investor to sell. And so we won't go in oftentimes and buy it at NAV. We'll buy it at some discount with an immediate markup when we put that into the fund and then begin to value that. And so if we buy something for a 10% discount right at its first valuation period, we immediately mark up that NAV to its valuation, and that gives us a positive return. And so by incorporating secondaries at 25% of the overall fund and front-end loading those through the investment period, that helps us mitigate that J curve. I touched on it a little bit with the term, but the term overall is extended as a result of the underlying life of the funds that we'll be committing to. And so when we think about just the primaries alone, we're going to be investing into the primaries over the course of a 3-year period in order to capture a full cycle. So we want to make sure that any investor into the 2020 fund has the ability to participate in our best ideas on the primary basis globally. As managers raise capital, and managers on average raise capital over 3 years. So there's that participation over that 3-year period. At the end of year 3 of the 2020 fund, we will be in a position where we may have made a commitment, one of our final commitments in the fund, and that underlying fund manager then has a 10-year term with a few extensions. And so as a result, we're in a situation where that overall term of the underlying fund that you're considering with Vanguard needs to have that length of duration in order to allow the managers to fully invest and then to fully liquidate those investments over the course of a 10 and sometimes 12-year period. And then, Jamie,
Ryan, just to add to that point about investing over the 3-year time period, one of the areas we've tested quite extensively with our quantitative research team is this notion of diversification over a period of time. And by investment, Ryan mentioned that we get access to managers who come to market during that 3-year period. But critically important, our research has proven out the case that trying to invest equally over a 3-year period provides the best opportunity for upside with reduction of downside risk, because you're not dependent on any 1 year of overinvestment. Sorry, I just wanted to add that, Ryan.
Sure. And so your other question that you had, Brian, was around raising a fund each year. We've found that many potential investors like yourself would really want to have the option to have an annual allocation of private equity in order to be able to assess where your portfolio currently is and what your need for private equity is as you think about new commitments to the asset class and driving towards your target and ideal private equity allocation from an NAV perspective. And so offering the fund on an annual basis will allow you to determine what's in the best interest of your plan and the investments that you're making in order to determine, do I want to start to commit earlier on and reach my overall targeted exposure sooner? And so you can front end weight or overweight, I guess, the amount that you may commit. Having everything on an annual basis also gives you the ability to stagger commitments. So to determine how to drive towards your private equity allocation over the course of multiple vintage years to get that diversification that Jamie was discussing. And then, we've seen some investors who have said, I'd like to invest into a fund in 2020, and then we're going to not allocate anything in 2021 and consider skipping every year in order to further extend the underlying vintage year diversification. And so there's the design Well, investing over the course of multiple years gives any one investor in a fund the appropriate diversification, but then the frequency with which we raise a fund on an annual basis gives investors that ability to flex between how they want to allocate capital in order to reach their targeted asset allocation in the duration that they're targeting. And then, Brian, I'm sorry, the last question, it was IRR and net capital. I had sort of the balance between IRR and multiple and net capital. Are you referring to sort of target IRRs or how we think about underlying investments?
Brian, sorry.
Brian, I can't.
Yeah, I think you're on mute.
Sorry, got like two different mute buttons here. No, there are lots of different ways to measure performance in the private equity space, and obviously multiple of invested capital, IRR, which I think people are somewhat more familiar with, and also sort of the whole conceptually with investments, we're getting distributions potentially when we're also in the open window where we're getting capital calls. So is that netted, and then how do you calculate your performance when we've got, we potentially have inflows and outflows in the same given month? And so how do you guys, how do you look at performance? How do you measure it? And how should we be interpreting what you're telling us?
Yeah, sure. So the net capital concept is an important one, because if you invest $1 into private equity, because that $1 gets spread out over multiple years and invested into managers who are then committing that capital, it actually takes time for that one put into what would then show up on a quarterly statement as NAV. And at the same time, because of the secondary portfolio, because we're buying more mature assets, and in the case of co-investments over the course of a 3-year period, we are investing and selling those assets. There's inflows where capital is being drawn for new investments, and then outflows of distributions that are coming back. And so on average, we like to think about it as for every dollar that gets invested into private equity, at any one point in time, your net exposure into the asset class tends to be right around, call it 65 cents on the dollar, because of the flows that are going back and forth and the distributions that you're receiving. And so along the way, we're measuring a combination of the IRR as well as the multiple. So the cash flows that are going into those investments, timing of that dollar in, and how that gets spread out. And so it may be 25 cents gets called down in the first year, 25 cents in the second year. And so that goes in, and then we're directly accounting for that dollar in and the amount of capital that gets distributed back. And we're drawing our IRRs off the cash flows that are taking place, as opposed to, if you were to invest in a public security where you buy Microsoft on January 1st and you sell it on December 31st and you have a full year, that gives you the absolute return on that investment. In the case of private equity, because there are cash flows moving back and forth constantly across all the different investments, we calculate that IRR. And the money multiple here is really a function of dollars that are drawn, as well as the underlying NAV plus any realized value, so the total value of the underlying investments. And we're accounting for that through the money multiple calculation that accompanies those underlying cash flows. Did that answer your question?
Brian, this could be how, even from the Vanguard side, in just sharing like a moment of our take. So we, I'm sure Brian Bankley has communicated that this HarborVest offer and having private equity through this is our lead advice that we are recommending for all advised clients that are qualified in our endowment and foundation space. So this is our lead advice, and much of the questions you're asking about performance metrics were vetted thoroughly from the HarborVest level by our most senior investment committee, including our chief investment officer for Vanguard as a firm. So a lot of this has been kind of looked through the Vanguard lens as well, if this is helpful to understand how we thought about it. And your question on the annual vintages, this was ideal because this is our lead advice that we're making clear to all of our advised clients in this space. We wanted to make sure that clients could execute on it. And so it was really important for them to have the ability to invest each year. So this is, I think, Ryan has outlined quite well the investment rationale, but Vanguard's thinking from the other side to make sure this got accessible because the risk-adjusted excess returns are so valuable to client portfolios and investor outcomes. They were also really key reasons for the Vanguard case in making sure this is included as our lead recommendation for all of our advised clients. So I just wanted to add that color for those great questions you asked.
I appreciate that. And then my other set of questions are really around ESG, which I saw some pages in your deck. And thank you. And I spent some time with Vanguard's team on their ESG process. So I'm assuming that whole Vanguard thing, was part of their whole vetting process as well when they're picking who they're going to pair with. But my question actually goes, and you spoke briefly, and I'm sorry if you've already stated it, but what's the diversity look like on your equity partners?
So at the managing director level, the number of women is, Ryan, I'm afraid I'm going to get the math probably a little off. It's probably around 30 some odd percent right now. Is that correct? Across the director platform. And at varying levels, it drops and then comes back up again at the junior levels. I will tell you that from a ethnicity perspective and other diverse metrics, we are in good shape relative to the private equity industry, but frankly,
well, that's a low bar.
But frankly, we really believe this is an incredibly important area for us to continue to invest heavily. And we have taken some pretty significant steps of late in terms of our recruiting efforts, internship programs, and other areas to continue to bulk that up so that we can be a leader, because we think that this is a really important area for us to continue to focus our energies.
And so I saw your scoring or whatever, your rankings and some other stuff in it, but knowing the private equity space and the sectors that are involved and sort of the whole, how exactly, and you guys, because you're not just doing, I'm probably thinking on the co-investor direct stuff is front of mind. I don't even want to get into when you're doing a manager, when you're buying into another person's funds. Let's just stick with when you guys are doing direct. How are you implementing a process? You guys, is it you're sector agnostic and you've got some sort of an overlay where you're looking at how the company's environmental impact, or what their corporate culture is, and how, just help me through like how it shapes your analyst team when you guys are looking at investments.
Ryan, you want to spend some time on the scoring methodology?
Yeah, sure. I'm happy to. And so we have a scoring system that we use, Brian, which is cuts across all of our strategies. On the primary side, we're basing our assessment on a detailed questionnaire as well as an operational due diligence assessment that's done by a separate independent team from the underlying investment team, so there's no conflict of interest. And that ODD team is also completing ESG review alongside of the investment team to evaluate environmentals, social governance, all of the key characteristics that go in to thinking through how a private equity firm is being managed. And we're scoring that private equity firm on a combination of at the manager level, so the GP level, how they're thinking through each one of those issues, how they then fold that into their underlying investments, and so how they work with their underlying investment teams and management teams in order to implement best practice. And then we're also folding it into how those underlying portfolio companies are reporting back up to the underlying manager and how that manager is reporting to the advisory board. So they're getting scored not only on the depth of their ESG capabilities, but also on their ability to then report and take that information, track metrics, and share those with the advisory boards for input. In many cases, we have helped our underlying managers go through and create their ESG policies. We have a team that's dedicated to ESG, which checks in on a quarterly basis with the underlying managers to understand where they have best in class or best practices, but also where they may have deficiencies and may need to improve, oftentimes from our scoring. And then it's more regular ahead of advisory board meetings and annual meetings when we go to see these general partners. There are usually issues that get raised. And even in the case of the COVID situation, we more recently have gone out to all of our largest value positions, and we've talked to our managers about whether they've taken any sort of measures to identify and address key operational ESG impacts on the portfolio, how they're thinking about tracking that data and any sort of job retention and losses to the underlying workforce, how they're looking at risks around discrimination impact and any sort of litigation costs that might be associated with that. How are they evaluating diversity breakdown? And so there's a lot of sort of steps that we are getting behind on the ESG front to incorporate that into the primary side of our business. And then on the direct side, we are co-investors in the businesses that we invest into. And so we're alongside of sponsors. Oftentimes, these are our best idea sponsors that we are very close with. We know their ESG capabilities from the way that we've rated them on the primary side. And so on an asset specific business going in, our direct team will utilize our ESG reports. We also, as part of our offering on the co-invest side, have Bain consulting on retainer, which is a differentiator on the co-invest side, and general partners find it very valuable, but oftentimes we're able to do studies on these areas for us. If it's an area of concern that we may be concerned about when it comes to governance, or if it's a specialty chemicals business, environmental, we'll utilize Bain and complement with the underlying general partners already doing in their core due diligence. And because we try to get involved in our co-invests much earlier than the balance of the market, a lot of deals get syndicated late in the process. We oftentimes don't participate. We're often co-underwriting with the general partners. We, as a result of that, get access to all of their due diligence very early and flag many of these issues and work with the general partner. So while we're not the lead sponsor, we're in a co-investment role. We try to be as active as we can in helping support them to get the transaction done, but all of the other pieces that make for a good investment come into consideration.
And Brian, just two other points to make. This scorecard that Ryan has talked about, one of the areas that we have focused on is benchmarking managers against peers and peer groups as a way to advocate and push for change. And that's, again, some of the roles that we play as an advisory board member within those GPs, but also in the industry. And then finally, those grades that we highlighted on the slide are PRI's grades for our various underlying investment strategies, and we're quite proud of them. We've been part of PRI for quite some time. Importantly, last year, with a clear recognition that, again, we need to continue to improve, we hired a woman by the name of Natasha Buckley, who was the private equity person within PRI, doing all the assessments of the private equity managers. And so we feel like we've accessed somebody who's now helping us continue to get better and better in this space. And she is challenging us, which is great.
And then Brian, just I went as you asked the question to Jamie and he answered it, which was his answer was correct. I wanted to get more details for you. And so overall, the breakdown between male and female at HarborVest, the overall workforce is 5% male and 45% female. When you get to the managing director level, it is that 70-30 split, 70 male, 30% female. And then when we go to the ethnicity of our workforce, it's about 69% white, and the balance 31% ethnic minorities. So we're continuing to focus on it, but we do feel like we have a diverse workforce. And as Jamie mentioned in his opening remarks, 4 of our offices globally, 4 of our 10 offices globally are managed with heads who are female.
Great, thank you. Are there other questions from the Fairfield side? Well, hearing none, it's a big difference from last month. I really appreciate Brian and Jamie for you guys coming and spending part of your evening with us. And Brian and Ariel, thanks for setting this all up for us.
And Brian, on behalf of HarborVest, thank you for having us. And Eric, thank you for inviting us. Ryan and I are proud to represent our organization. We're proud of the partnership that we've created with Vanguard, and we'd like nothing more than to welcome you as a client of the firm and continue to work on helping you achieve your long-term objectives. And I hope that next time that we get to meet, it's not virtually and it's in person. I have family in
yeah. And pass on my regards to Ed Powers. I met him pre-COVID. I think it was the New York Common. I think you guys managed for New York Common. I met him at that conference.
Oh, you met him up at
their
annual event?
Yeah, it was the Albany Emerging Managers Conference.
Yeah, that's a terrific event. I went last year with Ed and the team.
The timing on Valentine's Day, I have a little bit of an issue there, but but I can't choose.
They are the client, Brian. I go when the client likes to see me.
Yeah. Thank you, gentlemen.
Thank you. If I can just add a comment before everyone leaves. When we're assessing this, so thank you for our HarborVest partners to coming on. It just shows the commitment from their level in partnering with Vanguard to make sure our clients get all the information, that they need. And so part of this whole partnership we talked about in selecting a partner was that philosophical alignment, so important between those two firms. And so hopefully that came through with having them join us and make the time to do that. That's really important, again, that the committee understands everything before making an investment. And just what we're looking for, what's consistent with Vanguard, whether it's public equities or private equities, is from a manager search perspective, we're looking for talent. We've clearly think we've identified a top tier partner in the industry. Of course, we talk about balance, and the team has talked about that. Diversification is something that Vanguard always preaches, and that's what we have here in the HarborVest Vanguard Fund. Cost, we didn't talk about fees today. We did talk about that at length before, but consistent with the Vanguard philosophy of keeping costs low, the offer that in the partnership you have with HarborVest is not something that any of our clients can access on their own. And then it's just patience. We didn't talk much about the asset class, but of course, private equity is different. You have it in your portfolio, but for the new committee members, this is a long-term commitment. And needing that patience to realize those excess returns like private equity has already done in your portfolio. So I would just stress those points. Thank you to the committee for all the questions. Thank you for HarborVest.
Brian, thank you very much.
Thank you.
We'll take our leave and let you continue your agenda. Thanks again.
Good night, everyone.
Appreciate it.
Thank you.
Bye-bye.
Great. So next item on our agenda, if folks recall, I handed out and spoke briefly, I believe, trying to remember, about legal monitoring services that the town uses and potentially adding another vendor or law firm, Wolf Popper. And I don't know if folks had time to look through the material or had other questions. We certainly can have both of those firms. I can invite them to a future meeting where they could go over what they've done salient points of the program, whatever you guys would like. But we didn't vote last month because we didn't have a quorum. But are there any thoughts from the board pertaining to this issue? Questions? It's quiet.
Brian, it's Ken.
Hey,
you
Ken.
hear me? Hello.
Yeah, I can't believe you did not ask a question in the last group thing. That's just amazing.
Well, I just want to, I like to, duck and cover like Muhammad Ali and keep you guys off balance. Can you just describe, Brian, because I think you know a lot about this topic, I don't, the benefits of having potentially having two of these firms doing this on our behalf?
Yep, certainly. Obviously, I know a fair amount, having worked for many of these firms, and I usually start with the negative. So why is it bad to have none or one? And my thought is that, so what they're providing, it's beneficial. It's keeping us, making sure that we're getting claims submitted for cases where we have a valid claim, so we're getting that money back, and we are seeing that with Pomerantz, so they are doing that. The flip side is also, but we have no way to monitor. We have no way to know if they're capturing the whole market and if they miss stuff, because we don't have the resources to stay on top of that. So there's that. So you get some redundancy, and then the flip side. So now we are involved in a class action as a lead plaintiff in a lawsuit. And part of that's because Pomerantz brought that to us, suggested something, gave us a fee schedule. Like what would we, not only will we be paying, but when you're a lead plaintiff, you actually are signing an agreement for the entire class. So whatever you agreed to pay Pomerantz, you've actually now just signed. If we get lead plaintiff, you just signed up the entire, anybody who submits a claim in that class action, you just set the fee for everybody, which is, to me, it's a big responsibility. And so why is it great to have multiple firms? Well, one, you can say, oh, well, Pomerantz brought up this case against Floor and said that there's some merit to it, and I'm going to go ask Wolf and Popper what they think. And that firm, knowing that there's somebody else that checks and balances, you would think, well, 30%, up to 30% contingency fee for doing this. I mean, we know you guys do a lot of hard work, but I wonder is that like, a way for us to, when you don't have multiple players, you have zero leverage. And so I think as we understand, or maybe people are starting to understand, and that having some leverage in the marketplace is always a great thing. More information is always better, especially when it's free. We don't have to pay for any of this. So, and the reason we don't have to pay for it is because the law firms hope that they get lawsuits where they can charge these big fees, and that more than covers their cost of this free service. So nothing is free. And as far as I'm concerned, as long as they're not intrusive, it sort of runs in the background. They get access to view the portfolio through the custodian. That's how they know what our exposures are. They also, for filing purposes and for potential claims, like future claims. That's how the system sort of works. So that's why I think it's prudent to have more than one. Did I lose anybody or confuse anybody? Does that make sense?
No. I mean, the reason I asked the question is that there are few things that appear to be a no-brainer, and without knowing much about the topic, this one sort of seems to fit into the no-brainer category. I don't really see any downside to allowing two different firms access to our portfolio. It's public information anyway, right? I mean, anybody can find out what's in our portfolio.
Well, I'll just clarify on that. So they can know what funds we're in and what managers are using, right? Because that information. But
Right.
to say, to look through, like say back, the recent future when we were with Boston Company, where we had the exposure to floor, by the way, in a separately managed account. The public are not, they won't, they're not going to get the clarity of the holdings there unless there was some sort of a 13F filing or something where they could see what Boston Company have. And even then, to be able to trace that back to what that Fairfield held those things, so they won't know that level. They would just know that, like the Allianz recent thing, there's a giant, so folks know there was a publicly announced that Arkansas, I don't know if it was Arkansas Teacher or Arkansas State, lost like almost $1 billion in the Allianz funds, and they filed an individual lawsuit. It was this week. I think it was on Monday. But so that's a scenario where people can know that you're in with Allianz, but not know the details of exactly what fund and stuff. So just want to clarify that. No, they don't know the exact holdings. Like people don't know how much Apple we hold. And actually, I can't tell you how much Apple we hold. I'd have to ask Brian to go and, well, it's a lot easier now. But when we had multiple managers, we'd do some roll up on exposure, potentially if we had some overlap with managers and stuff. So at the individual company exposure, it's doable, but it's not a piece of cake. And we did potentially have multiple companies helping us in this regard. Bernstein Lillowitz at one point in time, many moons ago, at least 6 years ago, offered up the service. And I don't know if Bob was here or if it was going back to Paul Hiller. We said, sure. I don't think it got brought to the board. But I've never heard anything from them, so yeah. I don't think we're getting. If they are monitoring, they're really doing a very quiet, bad job. So Wolf Popper approached, and I figured it cannot hurt to add them.
Is this something you'd like to put to a vote tonight?
Yeah, I would. I think it's important that people understand that it exists and why it exists, and that we get monies from it, and it's a vendor, so that's why I think it's important to vote. I don't just say about all our vendors, whether it's an actuary or our OCIO. I think everybody should be cognizant and vote on stuff like this. And I apologize if it seems overboard, but I think it's a good practice. So I'll make a motion to approve Wolf Popper for portfolio monitoring services for the town of Fairfield's pensions.
I would second that. This is Ken.
Right.
Did you hear me?
I did. I got the second. So I was just saying, is there any discussion? Hearing none. All in favor?
Aye.
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 Any opposed? Hearing none. Abstentions? So moved. And I'll let the record reflect that Walter Burke is also listening in, and he's on the listen only line, and he texted in an aye. so Walter is one present and two voting. So, all right, great. So that takes us, I think, to the CFO as the next item?
Yep.
Caitlin's nodding. So
yeah.
I will just say, before I hand it to Caitlin, she's doing a lot of work with the whole transition stuff, and we're not done yet, because Wellington has got the most bizarre person in charge of letting us take our money out of that daggone fund. The State Street person, actually, it's not really Wellington, but I appreciate the effort. It's been, we'd be we'd be in trouble if you weren't on the ball. Go ahead, Caitlin.
Yeah, it was a lot. But that kind of rolls into the CFO report. So clearly we had a lot of activity running through the funds account, all of which Brian from Vanguard kind of walked us through already. So a lot of that came in through people that then out to Vanguard the first couple of days of July. Clearly all of the benefit payments went out July 1st. That was, and I'm just approximating, about $2 million. Also mid-July, we moved over half of the employer contributions for the year. So that was about $6 million. So that came in on July 17th from the town, and it was then subsequently invested right away over to Vanguard for our allocation model. About $5.2 million of that was moved over with Brian Binkley's help straight into Vanguard, and the difference being for the benefit payments for 8/1. So we are all set now for our August 1st payments as well. The only other small piece of activity that transpired in the what we label the funds account are just some small account fees that came out of about $13,000. So other than that, I believe that's really going to be it unless we get any other capital calls or anything for the month of July, and we are all set for our August 1st. And like Brian Vahey just pointed out, we have one more transfer from Wellington. The paperwork is in. We're hoping to get the sign-off call shortly with a September 30 actual date for the quarterly redemption. And that will be the last of the managers being liquidated.
Yeah, and so Caitlin, I should have CC'd you. I was sort of getting into it with the person over in wherever they're located, somewhere in the UK. Yeah, because I'm totally befuddled by their process, and I really think it's ridiculous. But I gave Ken Brackfeld, I gave them your name and phone number, so you might get a phone call from somebody with an accent from State Street asking if we are indeed in Fairfield liquidating our Wellington hedge fund exposure. And I would just appreciate if you would say yes. I also put Carolyn Trabuco's name up there, so hopefully she will understand.
Well, I'll only say yes if it's a very heavy accent.
I just don't understand how it's supposedly some security, but they're asking us to provide the person to call and the phone number. And I'm like, well, if I was doing something bad, I would give them my buddy's phone number and say it's somebody on the board and their phone number. And how would they even know that I'm not pulling some giant heist? It's the craziest system. I just stopped because it's not worth it. They'll be out of our hair. But I totally disagree with their protocol and controls, and we'll just leave it at that.
I think Ferris Bueller used that tactic in the movie.
Exactly. It's like
you listen to me, Buster.
We're going to like, hey, call my son. He's going to, no, definitely liquidate that hedge fund. Send it to 1625 Melville Avenue too, by the way. And the other thing I wanted to bring up, and Caitlin and I talked about it, and I don't know that everybody understands it, but when she was speaking about the town's contribution and the timing, because the way the tax rolls work and when the town sees revenue, it wasn't always clear to me, and this is my 10th year, exactly, the town's committed to this year they're doing the ADAC ARC of a certain amount, and when do they write that check? Do they do that check, right away? Do they wait 11 months? And the logical common sense thing is that, when revenues come in, so we have tax rolls and timing, so the town gets a significant influx of money, a chunk gets paid then, and then a chunk gets paid, we're kind of matched up. They make contributions that are sort of matched up with when their revenues come in, which makes sense. Whereas the employee ones, I guess, come in, what was that again? Is it monthly or I guess it comes in every paycheck and accretes. And then that's where the cash balance builds up until we say, oh, put that to work, put it in. So that's how you see the two flows, the employee contributions and the town contributions. And I never knew the town side of it or sort of paid close attention, but I think it's a useful thing to know. And I think it's good that we put the money to work as soon as you get it, right? The earlier the better. So in your own personal accounts, it's always better to invest. If you're going to invest in 2020, it's good to get it done in January rather than December, because over the long term, that lag of sitting, it will impact your long-term returns. And I think that's what's next on the agenda. New business, old business? Just guessing. Old, yep. Is there any old business that needs to be discussed? Hearing none. New business that we should all know about? Eric Caliper, I saw a hand.
Just briefly, I know we spoke a number of months ago about bringing in the deferred compensation people. I know we had some concerns about specifically the number of funds, whether people were drawing down loans from some of the 457 plan. That oversight kind of escaped us with this whole transition with the post-CIO. It'd probably be maybe a nice fall meeting to bring ICMA and that side in to kind of give us an update on what's going on in that realm.
Yeah, we've also had turnover in the HR department. So, yes. Chris, can you make a note for, we're not going to have a meeting, so everyone knows there's no meeting in August. So for September, I'll have to try and see. Caitlin, can you see if, I guess is that Hooker? Hooker should be able to.
You want Hooker and Holcomb, or did you want ICMA?
Both.
Okay.
Yeah, I guess it's both.
Yeah, and that's probably, I mean, I don't even know how much Jim actually knows. He's one of the key players now with the CFO, and I know just went up, for a CFO position. To do the direct oversight on the 457.
Yeah, and the town legislative body is supposed to actually be changing the ordinance of the code. It's a little gray about our body being fiduciaries. It's not black and white, and both sides have said they're going to do something, but I'll have to follow up on that on my own. Get that done before I get out of here. But it's another good point. But yes, for bare minimum, we should be speaking to both in September if we can do that. Set some time aside for that. And thank you. Any other new business? Nope. Okay, great. Then did I hear somebody make a motion to adjourn?
Yeah, that was
Eric
me.
Caliper. Oh, no, it's Jack. There you go. I knew it was Jack. And I heard three people follow themselves to second that. Who was that?
I seconded.
Who's the I second?
Aye.
Tom McCarthy seconded it, and we're getting votes already. So here, everybody's. Are there any? We're all in favor. Nobody opposed. So moved. Thank you, everybody. Have the best kind of summer that you can. Eric Caliper can show you how to make a makeshift pool. I saw that today. Something about a tarp and a trailer. I'll let you just have that conversation on offline. And thank you all for your time. I appreciate it.
Good night, all. See you in September.
Night. Good night.
Yes, sorry.
Thank you,
Bye-bye.
Brian.
How about
This session is no longer being recorded.